Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with Steve Selengut. Steve, go ahead and tell the people a little bit about yourself.
Well, Troy, I've been a investor since I was 25, and that would be from
a couple of years ago, right?
Yeah, around 1960. I became a professional investor in '79 when I left my job in New York and started my own investment management business with two of my closest friends. And then to sum it up, just last year I sold that business, which had grown to 110 million in management by me personally, part of a group of three people really that were managing it, about three times that. And I sold the business in May and I started a coaching business, and I wrote a book called Retirement Money Secrets, which really coincides with, what you're all about, the dividend aspect, because it's all about income.
Mm-hmm.
It's all about becoming income independent. And I have my own definition of that. And I'm sure we'll get to talk about that, but that's who I am. I'm 78 years old and still working as much as I can for people who need to learn about dividend investing.
Yeah, that's really cool. I like that you because a lot of people, learn things like everybody learns things throughout life, but like the people that do take the time to write a book, or like in my case, they take the time to make videos and stuff like that where they're sharing their knowledge. Like I always appreciate that, because like you can be greedy and just hold all the knowledge for yourself, but you're just like, hey, I know these things. I want you to know these things as well. So that's really cool.
Yeah, and with me, it's my approach, the way I look at things. I focus so much on income, whereas the world pretty much focuses on market value.
Mm-hmm.
And I look at market value as the thing that creates opportunities to buy and sell.
Mm-hmm.
And if you have the right quality in what you invest in, and dividend, the sign of a quality company, for example, is the fact that it pays you a dividend.
Mm-hmm.
It means they can afford to do so, and it means that they respect the fact that you own them.
Yeah.
You're a shareholder.
Mm-hmm.
So I've never, ever bought a security of any kind that didn't pay a dividend.
Yeah, I'm on that boat now. I'm sure I have. I think one of my first holdings, I've told my story before. I actually started on Robinhood. One of the first stocks I bought, like, here was my screening process when I first started. Open Robinhood, go to the part of the app where it would tell you the biggest winners and biggest losers from the previous day. And I just bought the stock that was the biggest winner from the previous day, because if it won yesterday, it's got to win today. That's how it works.
Okay.
So I bought that. I think it was like ARCT or something like that. It was R Therapeutics Holding. Again, no idea what I bought, but it had like a good stretch where it was like 3-4 days in a row. I was up like 4, 5, 6%. And I was like, oh, we're doing this investing stuff's easy. That was like May-ish. April, May-ish of 2020. So that's when everything was going up and everybody thought everything was easy. So, but here I am. I stuck around. I made it through 2022. That was a not fun year for a lot of people. So we did it. I think I'm officially a committed investor. Like, I'm not one of the, meme stock investors anymore, because I made it through the bad stuff. I know a lot of people that did start during that COVID stuff.
You made it through a little bit of bad stuff.
Yeah, exactly. I know there's obviously, and like the crazy thing is, like, I did an interview with Dividend Dave from Twitter a while ago. That was actually the reason I started the show. So shout out Dave. But when he asked me, he was like, oh, when did you start investing? And I was like, oh, in 2020. He goes, oh, so you were primed for like the good deals and stuff. I was like, well, that was under the impression that I knew what I was doing. Like, and I didn't. So like, I didn't know what a good deal was. I was like, oh yeah, Apple's down 40%. I don't know what that means. Like, I had no idea. So I'm definitely ready for the next one. And that's what I look forward to. I always say like half of more than half of the battle in investing is like the emotional and psychological part of it. So for me, I've just figured out ways to like manipulate my brain to be like, okay, no matter what's going on. And that's another great thing with what you're talking about with like market value of your stocks. With dividend stocks, there's pros to both. So like how I like to, this is a little tangent, but like how I like to look at it is if I buy Apple stock and I own Apple stock at 180 a share or whatever, if Apple goes down to 170, yeah, my shares are now worth less than they were, but now the new shares I'm buying are worth, like I can get more shares with the same amount of money I was just going to buy. And in the meantime, with dividend stocks, you get paid to wait. So like that's how I manipulate my brain to like, oh, I don't get emotional behind the number that it just went down. Now I'm getting what I was going to buy anyway on sale.
Okay.
So,
I can see where you're coming from. I was a little bit like that. We didn't have drips when I started.
yeah. Well, you had to pay for like all your trades and stuff, right?
We had commissions. Yeah.
Yeah.
We did. We dealt with commissions. Of course, we had different SEC rules, which were applied to an individual company like myself, just like it was to Merrill Lynch. I mean, I could tell you some stories about, SEC audits that I've gone through where, they came into my office and they couldn't believe they're in this little room in an office building, and there's me and a secretary, and that's it.
I've listened to a couple of your interviews, and I have a question that I don't think anybody's asked you yet. So, you being in the investment management business, right?
Right.
When you were doing what you were doing, because you've been doing that part of things for decades now, right?
Since 79, over 40 years.
What was because as you were mentioning the SEC, I've seen the Bernie Madoff documentary on Netflix. Obviously, I was born in 94. I didn't know what was going on, like all that stuff. So like, did the SEC was given tips on Bernie Madoff for, it seemed like decades, and they just didn't do anything, or they didn't do proper due diligence on that. So like, did that change anything that you did? Obviously, I'm not saying you obviously didn't do what he did, but like, was it more strict afterwards? Like, how did that go?
I didn't notice any real change in rules. What he did and the people that he manipulated, I think he targeted an audience that just didn't pay attention.
Yeah.
They made a lot of money. They had agents take over from there, and they found this guy Madoff that showed them account statements, for God's sakes.
Yeah.
I mean, he had a pretty good manipulation going on. Today, things have changed in the sense that a client, when I was up until May, a client couldn't even send me a check to make a deposit into their account. They had to send it directly to the custodian. So those rules had changed. I mean, when I first started, I remember driving up from South Jersey with a briefcase full of about $1 million worth of Exxon stock certificates.
That's like paper.
You never seen a certificate.
Yeah, I've seen them on the internet.
I'm going to show you later. I'm going to show you a coupon bond.
There you go.
I have a coupon bond on my wall here, and they don't exist anymore.
Yeah,
really.
That's cool.
These are the where you clipped one off, you walked into the bank and you deposited it.
Yeah.
It's one of those type of things. But anyway, rules did change. Those types of rules. You couldn't touch. I had one guy send me a check for a couple $100,000. I had to send it back to him. And that's not really in the client's best interest, because that means you got the mail going this way, the mail going that way, instead of it being invested. But you couldn't touch it. I couldn't even send it to my broker.
Yeah.
So that's how it changed. Before that, there was no problem. A guy could give me this restaurant guy used to give me envelopes full of cash when I first got started.
So was it harder to get, like, did you experience any like client fear when you were doing that? Like, because of that, did they think that everybody was related, the finance industry was corrupt, or how? No. Is that part of it?
No, I had a very close personal relationship with my clients.
Yeah, that's good.
I'd be in touch with them. I used to write a lot of articles that were just for them and explanations, and if the market went up or down or whatever, I would talk to them. I was always in communication with them. They never had a problem, and they knew where I came from. They knew my history.
Yeah.
When I first started, when I moved after I moved from Jersey down here, and I pretty much, and the internet got involved, and I started to becoming uh, all over the country, and I started to become had a couple clients overseas. Um, then I didn't have that personal relationship, which I missed,
Hmm.
of course. And then again, it started up again when we started to have Zoom,
Yeah,
in recent years. So I had clients that were I was working with for 20 years, and I'd never seen their face.
that's
You
cool. And
know,
then Zoom, COVID, and the whole Zoom
and
thing
and,
brought that
and
together.
things changed. So there
Yeah.
were a lot of good changes as well. But the Madoff thing tightened up the rules as far as handling the money, statements and stuff like that. I mean, we in my organization, I was there. I was the front man. I was the one that brought the clients in. I was the one that vetted them. I was the one that designed their portfolios and did all the trading. But I did it through the broker,
Hmm.
uh, the broker that was my partner really since the 80s. We didn't have any official partnership thing. I was an independent corporation actually. So um, and then they would place the orders with a broker dealer.
Yeah.
And for a while, in some of the organizations, when I was an RIA, I still had separate supervision by both the state and the federal government. And then 15 years maybe ago, that just got too cumbersome. And we moved to instead of one of those big full service brokerage firms like Merrill or, you know, any of
Fidelity.
those,
Yeah.
we went to a private guy, one that wasn't even publicly traded in Pittsburgh called Mid Atlantic Capital. And then they took over all the compliance work. So the SEC dealt with them.
Yeah.
I still had to comply with all the rules, but I was no longer a registered investment advisor. I was now an investment advisor rep.
Okay.
But they never bothered us. They never tried to change. Our approach to investing is much different than uh, the average guy, and it's been that way. It's first of all, it's income focused investing,
Hmm.
purely income focused. My job my job when I was managing, my first job was to make more in capital gains than my clients were paying in fees.
Yeah.
So I was always taking profits. Um, when I first started investing, which was back in, I don't know how far you, I, my father was a compulsive worker. He worked, he left for New York 6 o'clock in the morning, came back 6 or 7 o'clock at night. And he ran a real estate development operation first in New York, and then he bought this piece of land on a lake in North Jersey called Lake Opatcong. And from the time he started running that development up there, I moved up there when I was 5, and I started to experience what he did and how much money they had.
Yeah.
My parents, I mean, compared to the people who had lived there on the lake all their lives. And I was curious, and he said, "You work." Basically, he was a big man of few words. When I was 12, I started a lawn mowing business. By the time I was 13, I had 2 of my friends mowing lawns along with me. Um, I was spending that money on myself, on a new boat, on this, on that. Still, I was too young to drive vehicles. I was driving a boat,
Yeah.
And and my father said, "You got to put some of that money away." So okay, why? He said, "Because you want that money to start working for you. You want to get like me right now. Right now, my assets work for me harder than I work, and you see how much I work." I said, "What do you mean?" So I've got a savings account, and then after it was a savings account, I just kept giving him 25% of the money I made, even in college, when I worked in the summers for his lumber yard. He'd get 25% of my money and put it away. He said, "The secret in this business, in real estate," and he said, "I suppose in any other business, I make money when I sell properties, but I make enough money to take the family out to dinner every week by the rental properties I have, by the mortgages I take back from the people who buy my houses, by the insurance premiums, my commission on the insurance premiums they pay on their properties, and so on. So I've got 3 streams of income coming in, and then I choose whether I'm going to buy an existing building and renovate it, whether I'm going to buy more property and build on it, what I'm going to do. I don't have any constraints on my operation because the market is tough and I haven't sold a house recently. I get the rents every month. I get the mortgage payments every month. So that's what he taught me. Income. Income is king.
Yeah. Well,
And so,
especially multiple sources and passive. Like that sounds like, I mean, obviously, like I know that now. It's really hard. I don't know why. And if any of my friends that I'm directly speaking about are watching this, thanks for watching. But like, I don't know why it's so hard to convince people that like, because like, you know, I just started dividend investing in 2020. So I'm not making, other than my special dividend I just got from Costco the other day. I got almost $100 from Costco just because, which is real nice. That's a nice early year surprise. But like, other than that, like I don't make a ton of money with any of my individual investments yet because they're still building positions. Like that's how it works. But like, even still, like last year I made almost $900 in dividend, and I have like a super low yield. I think my portfolio yield's like 1.97%. So like, I do that and none of them get excited, but I'm like, okay, well, when I first started, my first year was $27. My second year was $303. This year was $900. This year I'm projecting to do about $1,400 or $1,500. And I'm like, at what point are they going to get excited and see that like, this is money that I'm making that I don't lift fingers for. Like I'm just literally waking up, and whether I'm having a good day, bad day, the market's up, the market's down, I'm going to make $1,500 regardless.
So Troy, I'm going to show you this, and I'm going to send you a copy of this. You're going to send me your address. This is Retirement Money Secrets. Okay. When you finish that book, there's going to be such a big light bulb going off in your head. It will be just like the one that went off in mine many, many years ago. You talk about 1.2% and things, and I understand where that's coming from, and I understand it's the stock market. But what I use to invest today contains every one of those stocks that you own. I would bet that the closed-end funds that I use, and a closed-end fund it's a trust document. It's a trust entity. It's just like a stock. It has shareholders, but the trustees of this investment company have to pay out 95% of their income, and they increase that income over the normal dividends that the stocks bring in, like you're talking about, by selling, in addition to the IPO where they get their original shareholders, they then raise additional money to buy stocks with by borrowing at a rate lower than what they can get if they say buy utility stocks, for example, or if they buy some of the larger paying, or even now if they buy some of the larger paying ETFs or other CEFs for that matter. And then they also have preferred shares that they sell issues of preferred shares, and they use that income to buy more shares of the stock without adding to the shares of the shareholders. So in other words, when you let's say you originally bought 100 shares of, let's use Apple, even though it's not a big dividend payer. You bought 100 shares, then Uncle Jack just gave you another 45 shares through these exercises of borrowing a little money and selling preferred shares. So now instead of having 100 shares, you got 145 shares giving you the distributions on your same basis, so instead of having a yield of 1%, now you have a yield of, let's say 1.5%, or, let's say instead of 3%, you have 5%, stuff like that. So anyway, my yield, I have 100, I'm looking at a selection universe of 100 closed-end funds that own an average of 258 different companies, different stocks. Okay. You ready? The average dividend yield on this portfolio is 9.43%.
Wow.
And that's at price. That's last month's prices. I'm just doing the new ones. That was at December 15th. You talk about special dividends. In a good trading year, these things pay, and they have to pay out 95% of their earnings. So they trade, and their trading earnings will produce 30 of them last year, and over the last 3 years have paid special dividends at year end.
Yeah.
One of them, Petroleum and Resources, is what it used to be called. It's now called Aberdeen, Aberdeen Real Assets or something like that. Paid like has forever paid $1, $1, $2, $5 at year end, like you were talking about that Costco special dividend. This thing, I go out and I buy it in September. Every year it pays a special dividend. Last couple of years haven't been as much as in the past, and you can imagine back in the go-go days in the oil industry when there were buyouts in the oil industry all over the place, which you probably only read about in your economics books.
Yeah.
But in those days, I would be getting some huge special dividends at the end of each year. But I didn't wait around for the actual dividend pay because, as you know, dividends go into the stock price, right? So a thing says it's going to generate $1.50 dividend, it's going to go up probably by more than $1.50 because there are some foolish people who buy things on the dividend announcement and raise the price. So I used to wait until I got that the price went up so that I would, if I sold it, I would get at least 85% of that dividend, and I'd sell it because I didn't want to own the stock for another year before I got a special dividend. Because their normal quarterly dividends were peanuts.
Yeah.
You know, 10 cents versus $3. You know, so then I'd buy it again in September and do the same thing. There are several of these closed-end funds that have that type of thing, and I highlight them in purple because purple's wealth, right?
Yeah,
it's a symbol for wealth, and I highlight them so I make sure I look at them to buy them towards the end of each year. But anyway, I focus on dividends to a much higher extent. I buy dividend. Let me way back. So I was telling you that story of my father making me invest all that money. Well, he turned all that money over to his attorney, and his attorney apparently was an investment guy. So when I turned 30, that would have been in 1975. Still a few years before you came on the scene.
Yeah, just a couple. Yeah.
My father said, "Okay, here it is. Now you have to manage it." And he gave me a portfolio that was on almost six figures in 1975.
And is that from all the money that you made doing your side businesses that he's put back, that 25%?
He put it in there, all the money I made, and then all that the lawyer had made for me, but the lawyer did it with every stock I got. And I got Royal Dutch, Esso was at that time. Sears was actually a big name company at that time. You know, I must have had 30 different pieces of paper that I had to take to my broker and deposit. And
it sounds like such a headache. I'm glad we don't have to do that anymore.
Oh man, it really was. Oh, and you dealing with bonds was even worse.
Yeah. My stepdad is he was really big into like bonds and CDs and stuff, and I actually got him into the dividend stuff, and he does a lot of REITs and stuff like that. So if he actually watches this interview, he might be really interested in your closed-end fund stuff that you're talking about. So
closed-end funds. I used to do REITs. I didn't do BDCs that much. They seemed a little more risky to me. But REITs and master limited partnerships.
Yeah.
Until I got blown up on a couple of those.
Yeah.
But you can do all these things in closed-end funds. Like Cohen & Steers is a company that does a lot of real estate, and one of their CEFs is named Cohen & Steers REITs and preferred stocks. You know, another one is Income Realty. You know, so you can do anything you want to do in closed-end funds.
So what would you consider, like, because you know somebody watching today might be like, okay, these things sound too good to be true. So like, what's the con? What's the drawback? What's the thing that you need to consider when you're doing these closed-end funds?
You have to look really hard to find one, and people will use all different. The average age of the funds that I'm now owning in my equity universe is 21 years old. you know. So they've been around a long time. Listen to the names like Cohen& Steers, Nuveen, Pimco, Hancock, BlackRock, Nuveen, First Trust, Aberdeen, Gabelli. Um, these are not, said First Trust already, Eaton Vance, Calamos, uh, Blackstone, that's a different one, Liberty Group. There are 40 different large, uh, big companies. BlackRock's one of the biggest investment companies in the world.
Yeah.
They don't advertise these things.
Isn't BlackRock like the 9th largest company by market cap or something like that?
It may well be,
Yeah.
but they supply 15 or 20 tax-free. You're not ready for that yet. You don't need it because you're so young.
Mm-hmm.
Yeah. Tax-free income, average yield over 5%. Right now, BlackRock is the biggest provider of those. Nuveen is the second biggest. On the income side, I've got another 100 of these, and the average yield on those is 11%. They all own individual bonds, preferred stocks, mortgages, you name it. But the thing about them is, they're not new on the block. You've never heard of them.
I've heard of the whole closed end, the MLPs,
right.
the BDC. I've heard of that stuff, but like because one of my friends, I think he was actually my second interview, Jeremy. He's really big into that like high income stuff.
Mm-hmm.
And he talks about that stuff all the time. He has a YouTube channel, Dividend Stockpile. But
I got to get on that.
Yeah, so he talks about that stuff too. It's interesting, and it's just one of those things where like, so this is like kind of my follow-up question is like, are these similar? So like if I see a stock that is let's just say Apple, I think Apple's at like 0.6% yield right now. Right. Or I see a stock that is let's just say MPW. MPW is at like a 10% yield. It's one of everybody's favorite stocks for whatever reason. But like what I normally tell people, and again, not financial advice, I'm not a financial guy, I'm just a guy on YouTube, but what I normally tell people, what I would do is as I'm younger, I focus on the dividend yield. To me is just part of it, that like I want a company that pays the dividend. Obviously that's the kind of stuff I'm into, but like that's not the most important thing to me right now because I don't need the money. Like right now I'm just all about growing my portfolio, both in number of shares, and if I buy good companies, the dividend's going to grow, and as you said, the market value is going to grow. Apple going to keep growing, Microsoft going to keep growing, Visa going to keep growing, stuff like that. And then as you get closer to needing the income, that's when I am going to switch more into, hey, what can I take my money that's grown over the last 20, 30 years? What can I take that to and transition that into something that's going to not give me a 0.5% yield, but it's going to give me 8, 10, 12% yield when I need the money? So is that like the same kind of strategy or philosophy with the closed-end funds, or do they offer capital appreciation in addition to the higher yields at the same time?
They're not built for capital appreciation. Remember, all these companies that you're talking about, they're giving, less than 1% of their actual earnings to their shareholders.
Yeah.
These guys have to give 95%. If Apple or Amazon had to pay out 95% of its earnings, it wouldn't be where it is today as far as its price or its size.
Because they're not able to reinvest back into
the growth. The growth isn't going to happen. And remember, you're buying a company that's growing its net worth.
Mm-hmm.
And if the shares cooperate and your timing of when you want to start taking income is proper, you might benefit from that, but you're going to have to sell it all to do it.
Yeah. Well, and the big hope for me is just that like because like, so I don't know if you're familiar with like my three and my criteria to picking my stocks. So it's super simple because I'm not,
I like one part of it for sure.
Yeah. So the dividend
income,
part. Yeah.
The income part.
Yeah.
Go ahead.
So like the super simple approach is they have to pay and grow their dividend for at least 5 years, because that shows me that you are not only going to pay a dividend, everybody can do that, but you can consistently do it year over year through thick and thin. Especially the last 5 years includes COVID. So you didn't cut your dividend during that, a la Disney, AT&T, stuff like that. But so I like that. I like a stock that outperforms the S&P 500 over the past 10 years with dividends reinvested, because to me, if you're not going to beat the market, you might as well just invest in the market kind of thing. Like, I'm here to make the most amount of money. Why would I make less? And then the third one is I like a 3, 5, and 10-year dividend growth rate above 10%. I want that money that I'm investing, the money that they're giving me, whether I'm putting new money in or not, I want that to grow faster than inflation, preferably 3, 4, 5 times faster than normal inflation, not our not our recent inflation, but like normal inflation's 2.5%. So like I like it to grow 3, 4 times faster than that.
I think those are great parameters.
And like, I think
for stock investing, I think it's great.
And like, so what I've done is like, there's other channels I watch on YouTube and they have like very specific, they're looking at this in the balance sheet. None of that stuff's wrong. It's just, it doesn't click to me. So what I tried to do with my strategy is like, okay, I'm going to step back and I'm going to try to say, of the things that everybody else looks for that are in successful companies, what does that ultimately lead to? It leads to them outperforming the market. It leads to them continuing to pay and grow their dividend. And they generally do so at a pretty rapid pace. Like Broadcom, they kill all 3 of those categories. Like they've been doing it for a while. They grow it by a lot and they outperform the market. Just simple stuff like that. And I was like, some of the people that I consider to be very, very smart and way smarter than me, especially looking at balance sheets and free cash flow and all the stuff like that, they're buying the same stocks that I'm buying, but I'm doing it with things that I understand. And it's not to say that my way is better or their way is better, but I'm like, how can you make this as simple as possible that most people can understand? And I was like, these are like, if I say a streak of dividend payments, people can figure that out. That's not that you don't need to go to Harvard to figure that out. Outperform the market. Okay, mine did better than the market. Easy to figure out. And it grows its dividend by a big percentage. That's easy to figure out. More than last year. Like, it's not that hard. So that's really what I did. And like you said, if my dividend's growing at the rate it's growing, and I'm also buying and holding shares for long periods of time, so I don't know, some people don't believe in yield on cost. Some people do. My yield on cost for my positions is going to continue to rise to maybe something that is sustainable, to your point that I won't have to sell when the time comes, but maybe I will. And that's the other counterpoint.
That depends if you include your dividends that you reinvest as part of your cost.
Yeah.
Do you?
So right now I just use there's an app called Div Tracker. And that's telling me my yield on cost in addition to the current yield. So I don't know what it's calculating. I personally don't look at my yield on cost right now because, like I said, yield's just a byproduct of what I'm doing. But yeah, so I have all that stuff separate though. I can tell you how much I've invested in a company. I can tell you how much they've paid me. So I could figure out either one later on if I needed to.
Okay, my approach uses the very same securities because I've always insisted on dividends. But I now, but picture your portfolio times 1,000, multi-million dollars, $100 million in the very same stocks you own. Let's say it's one of these Gabelli funds, okay, that owns 309 different companies. Many of them pay dividends. You know, everybody owns the FANG companies. If you look inside these closed-end funds, they're trading these companies, but their structure is such and their makeup is such that they're paying a much larger amount of money that you can. And I don't drip. I selectively reinvest my money, so that if I have a company that's down in price from what I paid for it, I only add to a position if it's below my average cost per share. And I will sell different lots of that company. Like if I've owned one of these things for 10 years, I might have 6 different positions in it. And if one of the positions goes up to 6 or 7%, I'm going to take that profit and I'm going to reduce the cost basis and increase the yield of something else. I'm totally yield focused.
Yeah.
Where you're totally not yield focused. The fact that they pay a dividend and the fact that those dividends are increasing are very important. And all of these investment managers have that in mind because their purpose in life is to generate income. Even on the equity side, a young person like yourself should probably have at least 70% of their money in the stock market.
Hmm.
I did.
Yeah.
I did when I first started in 25. I took those shares and I put them together, and I did probably similar things to you. I did notice that every one of them did pay a dividend, which was important to me from the conversation I had had. And I tracked their stock price over the past several years. And I noticed that, they all kind of had the same general overall flow.
Mm.
The market was going up, they all pretty much went up, not at the same pace, but for anything special, like when you had the Exxon Valdez thing, you'd notice all the oil stocks went down. Things like that would affect their individual prices, but the dividends kept rolling in. And to my mind, you got to be profitable to have a dividend. You got to be profitable to raise your dividend. And as long as that was happening, the only thing I noticed about those stock prices is when they went down, I could buy more or buy something new at a lower price. And later on, I'd sell it. And I'd take that profit. And with my profits, I'd make sure I put 30% of my profits into bonds. And at those times, you've had to buy individual bonds. And I bought Fort Pierce, Florida, 4% coupon municipal bond, tax-free. And that was my first dip into the fixed income market. Then I discovered preferred stocks down the road. Then I started there were things called unit trusts, where you'd have a corporate bond unit trust, and they'd pay you back both principal and interest. And I never went to, like my father, I didn't go and loan people money as mortgages or get rental properties and things like that. I never really did that. I stuck in the stock market. I love the stock market. I traded and traded and traded that initial almost six-figure portfolio until the time in 79 when I said, okay, I'm going to do this professionally. I was making, and you're making money too. You just mentioned some of this. I was making 5 times my salary with the life insurance company I worked for.
Wow.
When I retired, when I actually didn't retire, I went out in a ball of fire, and I left them and started my own business. 5 times my salary I was making.
So
we were built, so these, go ahead, raise your question.
So like that's one of the questions I like to ask people, and you might actually be like, I don't know, I'm curious your answer. So one of the questions I ask people, especially that do dividends, is we can see the more money we invest, the longer we give it, the more we're going to make. And it's almost not that it's easily predictable to like 100% accuracy, but you can predict it with some accuracy, right? Like just, okay, if it goes up by this much percentage, like you can just do all that. So like you getting to the point where you could have, like you were making 5 times your salary. Did you want to start your own business because you wanted more? Were you just bored and you wanted to, like, because at that point you could have just called it quits and you could have been done, right? So like what made you keep going?
It wasn't that much money.
Well, you said 5 times. Well, okay. So yeah, so it's 5 times your salary. And then like, if that's growing and paying you more than you're already living off of, in theory, you could like you already won, right?
If it was, but my living expenses went up exponentially with children.
Oh, okay. Yeah.
Exponentially. Children with it actually, my let me say, my ambition to get even more money was the result of a birthday gift that my mother gave to my daughter. She gave her some horse riding lessons. So let me tell you, if any of your family gives your child horse riding lessons, give it back.
It's gonna get expensive, isn't it?
It is. They call it the sport of kings, right?
Yeah.
And believe me,
that's like getting a boat nowadays, right? Like everybody that you're like, you buy a boat, you're just going to be spending a lot of money on that boat.
It's a hole in the water surrounded by wood that you pour money in. That's what a boat is. Right. I've had boats.
Yeah.
But let me tell you, if I didn't have horses in my 30s and until she was 19, until she was ready to go to college, when she had to make a choice, you're going to continue riding or you're going to go to college. she made the right choice, fortunately. And now she's a vice president with some solar energy
Oh,
company.
I thought you were going to say she's a professional horse rider.
No, no, but I have a friend whose granddaughter is going to take that road. I mean, she's even going to college for equine studies and stuff like that. She's going to be in the horse business for her life.
Wow.
You know,
Is your daughter jealous about that? She's like, dang it, I picked the wrong one.
no, she's pretty happy with her lifestyle. I was not. I was really not going to go any further. Of course, my wife probably would have anyway, but who knows?
Yeah.
But those are the choices you have to make. But the investing choice, no, I wanted to teach people about this. This was pretty amazing to me. That I developed a process that I used to call stocks investment grade value stocks, and those are stocks for me that were dividend paying, profitable, traded on the New York Stock Exchange, blah, 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 all those fundamental qualities, not, oh, they have this X rating or XYZ is this and that. No technical stuff that I use, only fundamentals. So I knew that the ones I invested in had a very, very low chance of going under. That was the important thing to me. So, and I had a 10% target profit. I didn't do any of this lot trimming that I do now, but I'd buy them. I'd buy more of them when they went down, and I have a 10% profit target. And I never, ever said, oh no, it's going to go higher, ever. Because I had a list of around 240, what I called investment grade value stocks. And I knew that I could sell this Exxon and buy Chevron. I could sell this one and buy that one. And I always put a little bit of my winnings into my income portfolio as well. So I did that, and I did that, and I did that, and then finally, let's say 87. In 1987, way before you started.
Yeah.
We had the first 12 or 14 days of the year were up in a row. The market just went up and up and up until August. And I've been taking profits. And there wasn't even, I don't even think there were money market funds in there at that time. So you didn't really keep it in cash. You wanted to get reinvested. So I'd reinvest, but I'd instead of buying 400 shares of a position for a client, I'd buy 200 shares because I knew we were getting, I always, I think I have that market cycle painted on the inside of my brain. If I look at you, I'm actually seeing waves of the market going up and down. And I know, and I know when it's going up and it's going up for a long period of time, it's going to go down.
Yeah.
Okay. I mean, nobody ever thought it was going to go down like it did on October 19th, but it started going down in August, or it stopped going up, I should say. And then it slowly was going down. And this was when automation really started on the market, when instead of 100,000 shares of stock being traded in a day, that 1 million shares became more normal. I mean, this was the Dow. The Dow, I think, was not even 2,000 at that time.
Wow.
That's how long a percentage, 1% change was a big deal. But anyway, so we kept going, and we were, as the market was going down, and we were taking our profits, we started to trickle back into the market more and more, but we didn't leave any profits on the table in October. I mean, there was nothing over 10% profit in my portfolios, and we took what remaining profits we had then. But at that point, I mean, we were going in there and say, buy Pepsi at whatever, what's the price? All right, put it in $5 less. Buy this, buy that, buy everything that was going down at prices below the last trade. We were entering. And sometimes in those days, they didn't really have the limits on how far below or how far above you could put in your order. And we just bought everything when it was going down. And within 18 months, we had sold everything for profits.
Okay. So, I'm trying to remember so the question I have for you based on that is, it seems like for every saying, there's a counter saying that's either equally or less equally known. So, like, for example, like they say early bird gets the worm, right? Well, the counter saying to that is also popular is good things come to those who wait, right? Like you're either early to the party, you get the worm, or hey, don't rush things. It'll happen when it happens. Those are literally the same saying telling you opposite things. So one of the sayings, I think it's Buffett that says it, where he says that you don't want to trim your flowers and water your weeds. So like
Mhm.
I'm in listening to what you're saying when you're taking profits at 10% and then you're reducing your cost basis on ones that are lower. So like how is what you're doing different than that? And like what like how do you
Well,
spin that to like make it, actually work for you like it does?
well, a weed or a loser. I had never heard that Buffett saying, but remember, I have already pre-screened all these things that I'm investing in,
Mm-hmm.
you know, and every sector will have its own cycle within the market cycle.
Mm-hmm.
There'll be sometimes like recently when the healthcare industry stocks were than others. Sometimes tech. Look at the dot-com bubble. Look what tech had been
Mm-hmm.
doing, and then in the dot-com bubble, all the blue chip stocks started to rise as soon as the bubble went down. Well, I had never bought a tech. I never bought a Nasdaq company because I never buy anything without a dividend,
Mm-hmm.
right? So I didn't own any of those things. My clients didn't own anything of those things. My clients had a banner year that year, and their market values going up. The profits I was taking, the dividends kept rolling in because none of that was affected by the dot-com bubble.
Mm-hmm.
Just the tech sector was. So sectors are important, and you're going to have a sector that's going down, and that's where you will find the opportunities. I didn't buy anything in those days unless it was down at least 20% from its 52-week high.
See, you actually care. Like, okay, so one of my series on my channel is called the Power 5. Simply put, it's just 5 categories that I think are actually important to dividend investors. And the hard part with dividend investing is like what I care about, and you're seeing it in this conversation. Something that I care strongly about, you might care less strongly about, and something you care strongly about, I might care less. So like for instance, so it's like the dividend yield is one, the dividend growth rate, 10-year returns, the dividend streak, and then the percentage off of the 52-week high is one. And that's like everybody's least favorite thing, like that I mentioned. They're like, I'd want to know which one's touching its low and stuff like that. I'm like, well, to me, this one's supporting that at one point it was able to support a 52-week high because it got there for a reason. And now it's 20, 30, 40% off of a 52-week high.
But
This might be a good buying opportunity.
you got to watch out for 52-week highs on um, in long corrections like we've had. I mean, the stock market yesterday, the S&P briefly got above its January 3rd, 2022 high,
Mm-hmm.
but it hasn't closed above that high in 2 years.
Hmm.
So when you talk about 52-week highs, you've got to say, wait a minute. Any rise pretty much in something like this is now going to be near a 52-week high, because they've all just moved back up and they've been low for so long that the 52-week high bar has fallen.
Yeah.
So what I do now, because the tech is so good, I'll go on a thing like Yahoo Finance, and I'll just anything I'm gonna buy on the equity side, because the equities are income securities are not up, only equity securities are. So if I'm buying one of my equity closed-end funds, I'll hit that max button. So it'll show me the last 10, 15 years of this company. And if it's at a high, I'm not going to buy it.
Mm-hmm.
But there aren't that many of them that are. Like I can't give you a symbol or anything like that. But I found a few that I would say, okay, it doesn't meet my old parameters of, buy it below its high. So I'm not going to buy it because that's just not happening these days in interest rate sensitive securities.
Yeah.
But back to what you were saying, I am equally in love with the dividend that the securities pay and what the interest is paid on fixed income, preferred stocks, bonds, REITs, stuff like that. But the yield of the portfolio itself, the yield on the capital that you have invested in that portfolio, that's what's going to eventually pay the bills.
Mm-hmm.
And you're not going to be taking the risks you are today when you're 55.
Mm-hmm.
Right now I say, yeah, go for it. I would not. I like to selectively spend every penny of income I get. So when I get my dividends, and when I talk about getting my dividends, I'm talking about, I've been around a long, longer. I've been doing what you did,
Mm-hmm.
remember, since I was 25, and it worked, just like you're saying. So if any of your listeners, your followers, are hearing me, I did what Troy did. I had dividend stocks. I reinvested the dividends selectively,
Mm-hmm.
not by drip. I'd buy things. I'd add to positions. I'd sell positions and the proceeds back to work, just like he is. Only in dividend stocks, I added a income allocation to my portfolios immediately of 30%, just because because they paid a higher level of income.
Mm-hmm.
They paid tax exempt income. In those days, I told you I bought a 4% coupon. There were times in the 80s where you could get a 12% tax-free municipal bond.
Weren't savings accounts back then interest rates also stupid high?
Yeah. Oh yeah.
Yeah, my stepdad told me about that. He goes, yeah, we used to put our money in savings account and the interest rate would pay our bills. And I was like, that's insane, because our savings account, even now, I had a money market fund. It was giving me like 0.1%. And I'm like, that's insulting. Like, what am I doing with that?
Insulting. It should be illegal.
Yeah. I'm like, like because they're leveraging my money.
If they're only paying you 1.5, how is it they're charging you 6% if you go on margin?
Yeah. And then mortgages are 8%. I'm like, you're literally.
Well, mortgages did get down there.
Yeah. I'm just like, what are we, I don't know. Anyway, so I actually do the money market funds through Fidelity now. That's where the wife and I have our emergency fund in one of those.
Sure.
And it's just, I think right now it actually dropped. It's like 4.98%, but like you're just, collecting that money. So.
Back to my sales pitch for your approach.
Yeah. Go ahead.
Okay. And that's what I did. And I can tell you that from 1979, or rather from 1970, when I got that money, then I got that box of stock certificates and started investing using dividend stocks as my investment. In that short period of time, I made the equivalent of was probably $1 million doing it in today's money.
Mm-hmm.
And I was able to then start a business doing this for other people. So do what he's talking about. But there are a few ways that I think he will see, and I have seen, that you can make dividend stocks pretty much dividends on steroids. And you can do it with the same securities.
Mm-hmm.
If you were to set profit targets and take them and reinvest, develop a universe of companies that pay dividends, and have some of those high yielding utility stocks in there as well as your tech stocks. The few tech stocks that do pay dividends, have them as well. But when you get your profits, remember, like you said before, if you have $100,000 invested, let me make it $30,000 invested. If that goes up to 35,000, the dividends don't increase, the yield does not increase.
Mm-hmm.
Okay. So take some of those profits, make it capital, put it in there, buy another house on the monopoly board.
Mm-hmm.
Okay. Think of it that way. Your dollars are houses on the monopoly board. Only when you sell them at a profit can you buy another house, theoretically. Okay. So do it that way. Add new positions to your portfolios, but never let it go beyond a 10% profit. You could buy Apple. You could have done that with Apple 25 times on the way up. Okay. You could have bought it, sold it at 10% profit, bought it again when it dipped down a little bit, bought it again, and so on. The market value, the prices of these securities are always going up and down, not predictably, but for sure. And you can always use the market cycle to your advantage, and you're going to have market cycles throughout your lifetime of your investing career. You're going to see the market go way up, and trust me, it's going to go back down again. Mm-hmm. It just is. Even you young guys have experienced that little 2-month correction, that 2-month 40% correction in March of 2020, mm-hmm. right? Wow, was that a shocker or what?
Yeah.
But I was in there buying everything I could. You saw a slow year of 2022. Um, but your dividends probably increased, your
Mhm.
total dividends, because you're in dividend stocks and you're reinvesting it. And even though you're probably dripping it, your amount's still going to go up.
Mhm.
But think about if you had selectively put those in the ones that went down the most, because you've already quality checked these things.
Mhm.
Your dividend yield would have been even greater.
Mhm.
You would have produced more future income by selectively reinvesting it instead of throwing it all in one. The other thing about dripping is that you're going to create a poorly diversified portfolio in the long run,
Mhm.
because they all don't pay at the same rate. You're going to be putting more money into some than others, and you're going to wind up having 10% of your portfolio in one security.
Mhm.
You don't want to take that risk. Take the lesson of the Great Recession, which was really a mortgage problem, but nothing much more. But dividend stocks like Lehman Brothers, like Merrill Lynch, like several bank stocks went to zero. Okay. So if you're dividend reinvesting those things and are creating these positions where you have more than 5% of your portfolio in one thing, you're increasing the risk of your portfolio, regardless of how wonderful your securities are. Okay.
Mhm.
So the process that I describe in Retirement Money Secrets works just as well for a young guy starting out who wants to have what I had when I was 29, 5 times your work income coming in distributions, right? Without using any special securities like I use. It'll still work with dividend stocks, but the amount of money, monthly money you make will not be as much as it would be if you did the same thing with closed-end funds.
Mhm.
Much more exciting, but not as lucrative income-wise while owning the exact same securities as
Mhm.
closed-end funds would be.
Yeah, that's exciting. Well, thanks for the plug on that. And then yeah,
But
I,
really, I mean, I don't find a lot of people that can say I've never bought a stock that didn't pay a dividend.
mhm.
I can't find many of those people. You're
Yeah,
one of them.
yeah.
So,
Yeah, well, yeah, I've definitely never bought a stock on purpose. It's not, like I said, I bought that ARTC, and then so what got me into dividends, like I've told this story before too, is I opened a Robinhood account. I was watching a bunch of stuff on YouTube during the COVID crash and stuff. It was all that time everybody was into personal finance. That's what everybody was into. So opened a Robinhood account. The free stock I got was SiriusXM. And I remember one day, it was like in May, I had just got my phone vibrated and it said SiriusXM paid you 1 penny in dividends. And I was like, why did they pay me and what's a dividend? Like I was like, that literally, here we are 3-4 years later, however long, almost 4 years later, and I have a whole channel with talking about dividends. Like that 1 penny, quite literally, 1 penny got me hooked
right.
on what it was. And I think that's kind of cool. So
Well, that's great.
yeah.
Somebody, yeah, it's just like getting a check in the mail from somebody you don't even know.
Yeah, yeah, and like like I said, I'm the kind of guy that like when I go to the gym and I walk by a bench and there's like nobody there, but I see a penny, I'm not too. I'll pick it up. Like I like that penny. Like it's a free penny. Why would I not do that? So
Are we related in some way?
last year was a down year for found money. Like I didn't find that much. I forget what it was. I posted it on Facebook, but then the year before. I ended up making like 1788 or something like that and found money throughout the year. I'm like, that's free money. Like I didn't do anything for that. I just bent over and picked it up that somebody else wouldn't do. So
On the back of the book is this statement: if you saw a $100 bill on the sidewalk, would you pass it by, hoping that you would trip over 200 tomorrow?
no, I wouldn't.
Okay, it's the same thing. That's the stock market.
Yeah.
You've got a stock, it's up $500. Just tomorrow it could drop. You could lose that $500.
Yeah. Yeah.
It's there. Pick it up.
Yeah.
Find another one to invest in.
Yeah. I mean,
pick up that penny. Eventually you have enough pennies that you'll make the girl at the counter feel good when you put all this change in her tip jar, you know?
It's I don't know. It's one of those I don't know if it's a pride thing or just people think money's dirty or whatever. I don't know. I pick it up all the time. But
well, yeah. And you'll probably wind up helping a lot of people make a lot of money even as you do.
Yeah. I'm hoping that's like that's one of the points of the channel is like to show you that, hey, this doesn't need to be as complicated. You don't need to be a millionaire to invest. Like a lot of people are still under the impression of that. Like I know talking to my dad about investing, he goes, "Oh yeah, back in his day, like, you know, he'll be 60 in May." So like it's one of those things where he's
That's
like, "Oh,
about
you know,
right.
back in my day it was a little harder to get started. You had to have bigger amounts of money to get started. There was the fees and all kinds of stuff like that." But I'm just like, that's not how it works anymore. Like
That's
it's,
right.
you
There's
can
no
start with a
commission.
dollar, you can do fractional shares, you can like all these things are so easy. Anyone can
Right.
do it.
Right.
So okay. I think this is actually the first direct question, which is really cool that we've been able to talk this far. So first direct question I have for you is in your long time that you've been investing, what if you had to pinpoint one of your biggest mistakes, what would that be? And more importantly than the mistake made, I always like to understand what was the lesson you learned from making that mistake.
I guess one of the biggest mistake I made was that I didn't recognize the potential of closed-end funds sooner.
Mm-hmm.
Even though I'd been using the ones I mentioned, this ADX is one and PEO is the other, and they're not recommendations; they just exist, and they're two closed-end funds that pay these special dividends. Even though I've been using them, ADX has been around since 1929, even older than I am, and PEO has also been around that long, although it's changed its names once. So if you looked it up, you wouldn't see that. That I didn't see that I didn't understand what it was. I just thought it was a stock.
Mm-hmm.
You know, if I'd understood it was a whole different type of entity that had to pay out its profits to you, that was a combination of so many other companies, almost 100 companies in each of them. If I'd known that, I would have looked into it more carefully.
Mm-hmm.
And instead of, I probably have twice my personal wealth would probably be twice what it is now. And I wouldn't, instead of selling $110 million practice, I probably would have been selling a 300 million practice.
So
that's my biggest financial mistake I've ever
So
made.
was that like what the lesson learned behind that? Were like the reason that you weren't into closed end funds from the beginning, was that like a lack of due diligence on your part? Was that like, were you just skeptical of them, or like you heard of them and were like, not for
I
me?
hadn't heard of them. You know that they're the oldest form of fund.
I didn't
They're
know that.
older. They're older than mutual funds. 30 years older than mutual funds from back in the 1800s.
Huh.
Okay, and they're over 100 years older than ETFs. ETFs are in the 90s. They started. You know, so yeah, I didn't dig into it. I didn't recognize it as a different form of security. I recognized it was amazing when my wife's youngest sister got married. The guy she married had an investment portfolio, and he just wanted me to look at it. And I saw on that portfolio there were two Calamos. I think they were Calamos. Could have been Crumbine. Well, anyway, he had two closed-end funds. I said, "What is this?" And he said, "Well, my dad told me about this, and it pays this big dividend." I looked at it and said, "Wow, let me look at that." And that's when I really got into, said, "Wait a minute, this is a better way to own stocks. I can own a couple hundred stocks paying 8% or 6%, whatever it was, instead of 8 individual stocks or 18 or 35, however many I happen to own." And I started looking into them, and I slowly started my transition. I started my transition immediately from my income, from my bonds, my unit trusts, and my Ginnie Maes and individual bonds. I never bought another one. Never bought another. And all of a sudden, my account started, instead of earning 4% a year, they were earning 6 and 7% a year. Wow. And that's without any trading profits. In 2021, this approach, the dividend approach, was well, I'll give you percents. 9% was made on the yield on capital from the distributions themselves. Another 8% was added in capital gains and trading. So the one thing that you don't are not capitalizing on, and they call it capital gains for a reason. It means you've increased your capital. You've created money is what you've done when you take a profit.
Mm-hmm.
You've invested $1,000 in something, you sell it for 1,200, you've created 200 additional dollars of capital
Mm-hmm.
that you can now invest. It's like your uncle gave you a check.
Mm-hmm.
You know, so that's the only aspect of the strictly dividend approach, and the buy and hold approach that you're not capitalizing on.
Yeah.
In your approach. But I'm sure you've taken profits.
Yeah. Well, so one of my biggest things recently, and it gets one of the things where, part of me kicks myself, and then part of me, like, I moved on and realized that there's better opportunities, is I owned NVIDIA, which they technically pay a dividend, even though it should kind of be illegal that they say they pay a dividend. They don't grow it, and it's like 0.04%, that's really gross. So I own that one. I bought it only because one of the dividend groups that we're in, like, everybody, when I first joined the group, everybody was talking about it. You got to get into NVIDIA. You got to get into NVIDIA. I was like, okay, whatever. So I bought NVIDIA. It was good for a little bit. Then it went down a lot, but that's when I kept buying. I was like, okay, I believe, like, I do believe in what they were saying about this stock. I'm going to keep buying it. I built it up during all of 2022 into 2023. I think it was like April-ish of 2023. I was looking at my portfolio. I was like, okay, this stock does outperform the market. They don't grow their dividend year over year like I like, and therefore they don't have a dividend growth rate like I like. So I was like, let me just take my profits. I was up like 55%. Now, of course, market timing, how this works, literally like 3 days later, they had earnings and they shot up like 25% in a day. I was like, well, that's my luck. But I put that money into Costco, and like since then, Costco's up 35%. I've just received a special dividend of $15 a share on Costco. Like, it's all those things. And like, yeah, I missed out on whatever I sold it from and whatever it is now. But I put that money, the capital gains, I use the capital gains from there to like help even out my portfolio, follow my allocations. And then I also started a new position in a company it's my best performing company.
I know, that's great. Yeah, you never can look back when you take a profit.
Yeah. So yeah, I was like, what do they say? The bears make money, bulls make money, but pigs get slaughtered. Isn't that a saying?
Right.
Yeah. So like, it's one of those things. Just don't be greedy. Like, no matter if you're pessimistic on the market or optimistic on the market, like, you can make money either way. Just don't get greedy, and then you'll end up getting
and never think you know where the market is going.
Yeah,
because you don't.
Well, there's so many people that I don't necessarily follow anybody, but there's so many people. All you hear is like this fear. This guy says that this market's going to do. Like, look at what was supposed to happen in 2023, a recession, right? You would have missed out on the S&P 500 was, what was it, 24.95%, 24.45%. Had you been convinced that this year was going to be the worst year ever, even if you're just literally putting 10% of your paycheck into VOO or SPY or whatever, you'd have missed out on 25% gains because you were afraid, because you let them get into your head, because someone pretended they knew it was going to go on and nobody knows. That's what happened.
And it's up that much, and it's still not where it was 2 years ago.
Yeah, exactly. Yeah, exactly. So like, and that's one of the things that I'd like to do. Like this year, I was slightly under. I think I had like 21 or 22% gains in my portfolio, not including dividend, just like capital appreciation. So 22% gains out of the 24 or 25% from the S&P. But last year in 2022, when the market was down 19%, I think I was down like 8%. So like, it's one of those things where it's like, okay, I wasn't up as much, but I also was down by less than 10%.
Yeah, but I was up both years in capital appreciation.
That's good.
Because I'm growing so much income and taking what little profits I could.
Yeah.
And this year, I take, you're going to think this is crazy, but I take my top three profits every day.
Huh.
And that could be, if it's 1%, that means because the market's where it is, And remember, I'm in the interest rate sensitive marketplace.
Mm-hmm.
Everything I own pays largest dividends. So interest rates are more important than the stock market numbers. But I've been taking at least three, pretty much every day this year. We only had 9 trading days so far this year. And I'm taking small gains. Very small gains. You know how much money I made already this year? I made $8,000 already.
That's pretty good.
I'm making $1,000 a day, taking very minor profits, because in my market is the interest rate sensitive market. All prices in large dividend paying securities are down, and they will be until somebody actually moves dividends down again, which is not necessarily a good thing for the world and for the dividend investor for it to go back down again.
Yeah.
Because then your managers can only make X. Now at least they can make 6 and 7%. The last 12 years they've been stuck in a very low interest rate environment. So we're getting the benefit right now in the income side of the higher rates.
So one statement, one question. So the statement is you should do a YouTube channel. Because that would be really, like, I see a lot of people do like the live streams every day, and like people would get to watch like what you're taking profits on and why you're taking profits.
Yeah,
I think that'd be
I
really
wouldn't tell. I wouldn't be able to tell them. I'm still a professional investor.
Oh, okay.
And there are rules that I probably don't have to follow anymore, but I do.
Yeah.
I don't want anybody to take anything I say as a direct recommendation to do it, because their thinking may be different from mine.
Yeah. Well, that's when you put your little disclaimer on there and you're good to go.
Yeah, right. Yeah. So I don't, I show people where to go to research these types of securities.
Yeah.
And in Retirement Money Secrets, which I plugged again, I know.
Yeah.
But in there, I give you all the research help you need to get there, to determine which ones you want to invest in and which ones you want to avoid, and that's important.
Yeah. Okay, so now my question, I'm very curious your response on this. So you do the closed end funds for high income. In mid 2022, or I think end of 2022, all of 2023, there was a big craze from the yield max funds. Have you heard of those?
No.
Okay. So, I mean, that kind of poo-poos on the question, but I was just really curious.
How much were they yielding?
Unsustainable amounts, like 68%.
Oh yeah, I would never go near anything.
Yeah, so it was just one of those things, and like I'm part of I'm part of too many dividend groups probably, but I'm part of a dividend group on Facebook. Good.
I think I'm in the same all of the groups you're in.
Yeah, I'm in. So like probably like I guess probably too many.
I am too.
But one of the groups I'm in, I started hearing a lot about and it's actually my best performing video on the channel. But like all I did, I was like, okay, I'm hearing a lot about these things. From everything I've ever heard, dividends that are that high aren't sustainable. It's just like that's not how it works. Like it's just kind of a here it is and then there it goes kind of thing. So, and I was just like, okay, I want to know about these things. So all I did was like, I'm going to do the research I would do on these. And what it is, it's like I'm trying to remember. It's like a synthetic long covered call positions, stuff like that. And it's on, so TSLY is on Tesla or CONY is on Coinbase, stuff like that. So I was just like, okay, Tesla doesn't pay a dividend.
So it's on one stock?
Yeah, so they have a bunch of the TSLY or a bunch of the yield max funds, and each of the yield max funds that they have is doing synthetic long covered call positions on one individual stock at a time.
Okay, well, I guess, oh, geez, there's a movie on a lottery that was something like that. If you buy enough lottery tickets, you're going to hit a number so many times if you do the math. And that was the gist of this movie, that if you bought, hundreds of thousands of these lottery tickets,
you're going to go broke.
Mathematically, you're going to get enough little winners to make yourself some money. And that was the whole theme of this movie. But covered calls are the same way. Can you imagine if you could automatically or with investment software buy covered calls every day, a certain
for like
range,
every strike price
and stay above your cost, you could make money that way. You could make money. Of course, you'd have to do it. It'd have to be an automated process. And yes, I could say that probably could work. I wouldn't go there.
Yeah.
There are 4 or 3 ETFs that I use that are strictly covered calls, in addition to the closed-end funds I use. But there are closed-end funds, and a lot of them use covered calls.
Yeah.
Covered calls are an easy way to make money, but you have to make sure you're doing them in the money. Meaning, if you get called away, it's at a profit, not
Yeah.
at a loss.
Yeah.
You know, so
Yeah, it's not so that's something like in addition to these the closed end funds that we're talking about today, like the options like covered calls and stuff. Obviously, you need to have 100 shares. So like I haven't touched it yet because I have almost 50 shares in two of my holdings. But it's one of those things where it's just like I don't have the knowledge on it yet. But once I get closer to the 100 shares that I'm going to need for those, I would like my idea is as I'm learning covered calls and like options and stuff, I want to do literally the one that makes me the least amount of money just to keep like just do it months over months just to like learn the process. So because I don't want to lose my stuff. Like I
okay.
built it all this time. And like you said, if you do it where you're like, okay, if I say I do a covered call, however this works, covered call on Apple at 210, my cost basis is 160. If I lost Apple at 210, woe is me. I made $50 a share, but like, I'd rather still keep my Apple. So like, I'd rather do it like even higher and get less of a premium kind of thing.
Let's just a minute. A couple comments on options. I've never individually done an option in my life.
Mhm.
I've never bought a mutual fund either because it didn't meet my requirements. But still, options are very dangerous, other than covered calls, in my estimation, and very risky. I had a client once who had a six-figure portfolio with me, and this is when I was still doing stocks, individual stocks. He would buy the same stocks from in another portfolio and do the various types of options you can do. He would do puts and calls in the same stocks that I was managing for him. He managed to lose all his money in options. I think options are for professionals. This is just my opinion, and from my experience, the professionals that run my closed-end funds, if they're doing covered calls, that's okay with me.
Yeah. Well,
Because
yeah, and
I'm not responsible for it.
So options is the umbrella of all these different things, right? Like covered calls, puts, and stuff like that. Is like options is the big word, and then you get to choose like a call or a put. Is that how that works?
Yeah, put is when you are willing to sell something that you might not even own. So think about that.
Yeah, that's leverage like crazy.
Yeah,
Hey, I'll give you this thing. I have to go get it,
call,
but I'll give it to you.
a call means, I don't really know. And I know covered call means they're saying, okay, we'll sell you this position. You have the option of buying this position at this price
Yeah.
if you choose to. And I'd set that price above what I paid for it.
Yeah.
Right. So let's say the market goes up 10 points. Well, hell yeah. If I can buy that at this price,
Yeah.
I'm going to buy it and I'm going to immediately sell it and take that profit.
Mm-hmm.
Okay?
Yeah, that's what I understand about the covered calls too. It's just like, and then like you get a premium based on how likely or unlikely that is.
Right. You get a premium, and the premium is yours. It's income.
Yeah. Yeah. And like so I know like Jeremy, the guy I did for my second interview for the dividend stockyard or a dividend stockpile, he does that where he every month he goes and he updates it because I made this much in dividends, I made this much from options, and like he's doing well for himself, and his goal is to like retire him and his wife off of his dividend portfolio and stuff like that. So
yeah, and it might work. And even if he doubles his dividends, they will not be paying as much as the same shares in a closed-end fund.
Yeah. Well, he's the one that does the stuff like that too. He's the one that does the MLPs, the BDCs, the closed-end funds,
and the
stuff
CEFs.
like that. Yeah.
Good for him.
Yeah, so he's doing really well with that. And he's one of the ones, him and you, like once I get to that point where I want to do stuff like that, like you guys are going to be resources for me. I'm going to have to reach out and pick your brains.
Give him my name and tell him to get me on his show.
Yeah. Yeah.
Or send it to me and I'll write to him.
Okay. Yeah. Yeah. I'll get that to you right after this thing. Cause I got to get you my address too. So, okay. So a few other questions just to wrap up the show. So dividend investing is a very long game. You're not going to get rich tomorrow on dividend investing. It takes time to build up things. Unless you're doing closed end funds, you can get rich maybe next week, but not tomorrow. So
well, it's slow. It's a long-term game too.
Okay. So that's good then. So like what role? So first of all, what dividend achievements and milestones have you like recently achieved? And with those achievements and milestones, What role do those play in keeping you motivated since the game's so long? Like you hit these little check marks and you're just like, I'm doing something good
I still get a kick out of taking profits
every day.
every day. Yeah, every day.
Yeah.
And when I can't take a profit every day, that's a blue day to me. That's like a fine meal without wine. I
Yeah.
mean, really.
Yeah.
So I look inside at these lots because I'm reinvesting so much money. Um, I my IRAs generate $30,000 a year each. My personal account generates a couple 100,000.
So a couple
You know,
pennies here or there.
a lot. So
Yeah, a lot
think
of
about
pennies.
it. I'm investing, a lot of money every month.
Yeah.
So I'm buying a lot of different positions, and those positions fluctuate with the market more drastically than the entire position. Let's say I buy a couple, 200 or 300 more shares of XYZ on a position that has 1,000 shares, and I'm buying at a lower price, right? So as the market rises, that particular lot may go up 6, 7, 8, or 9% before the other positions even become profitable.
Mm-hmm.
So I'm going to take that 7 or 8% on that money stream, and I'm going to reinvest that.
Mm-hmm.
So with those little money streams, I'm accelerating the growth of my portfolio and the growth of the capital that's earning more income by
Yeah.
doing that. So unlike in a drip program, you're doing exactly the same thing, but the amounts that you're putting in are so small.
Yeah.
You're buying a less than one share
Yeah.
in some of your entities. What if you were buying 50 shares? If you used all your monthly income, you then buy 50 shares of one of those stocks instead of a half a share.
Yeah.
That's the difference. And as your portfolio grows, I mean, I'll have the first and the 30th of the month, I'll have enough money to start new positions.
Yeah.
Because I'll be able to buy something in the IRAs. Probably I could start a new 3,000 position on a small profit plus the dividends. So I'll start, and so my base is growing. When I look at my desk, I visualize 200 buttons. All of them represent one of these closed-end funds with an average yield of almost 10% at today's prices. If I sell any one of those, I can push another button and buy something that's yielding about the same amount without even thinking about it, so to speak, because I've researched them all and they've been with me for a long time. Every month, I might add one or two. Every month, I might get rid of one if it doesn't meet my expectations, or if it reduces its dividend for the second time in the year, something like that.
Mm-hmm.
So you have rules, but you just like you do, you have a hand-picked and molded universe.
Mm-hmm.
So you don't think twice. If you were to sell some Apple and Apple came into your range again, you wouldn't think twice about buying it again.
Mm-mm.
Because you've already done your research.
Yeah.
It's the same with this. I've done my research on all these. So if I sell it and I go back 2 weeks later, I'm going to buy it. I'm not going to, because I know it hasn't changed.
Now, do the closed-end funds have, what's that? I know a lot of people do this like towards the end of the year when they have like the tax loss harvesting and stuff, but then there's that, what is it? What's the rule where you can't buy the same stock in like 30 days or whatever?
All the rules are the same.
Okay.
In a taxable account, you have that same rule, but tax loss harvesting is the conscious exercise of taking $100 loss so that you won't have to pay $25 in taxes.
Yeah. Yeah.
It is about as dumb a thing.
I don't do it. I see a lot of people talk about it.
I'm sorry I said that. No, I apologize.
It's your opinion. You can. I agree. It's also my opinion. If you want to do it,
it's not something I would ever do.
Yeah.
I've had clients in all my years. I've probably gone through, because unfortunately I've outlived most of them or many of them. I've probably had 300 or 400 clients total over the years, maybe even a little more. Only 2 in that period of time had accountants that insisted that I do that tax law stuff. And every year I'd write my client a letter. I said, but on your client's advice, I've just taken $300,000 in losses on perfectly good investment grade securities because you wanted to save $100,000 in taxes. And I'd still get the same note from the guy every year. I've got to take some losses.
Yeah. So people, and to be fair, like taxes are, whatever, like it's annoying that you have to pay them, but like so many people are just like terrified of them.
I know.
And I'm just like, I don't like everything in life is opportunity cost. And it's just, okay, buying, like anytime I make a decision to buy company A, I'm making the same decision to not buy company B. Like that's how that works. So like, it's just like in the world where you only have $100 that you're going to put in one thing, you can't put it also in another thing. Like that's how it works. So like, I don't know. I don't worry about that. Like to me, my bigger thing would be like, okay, well, now's a great opportunity to reduce your cost basis on that stock instead of doing a tax loss harvest. But to me, and again, this is your opinion and my opinion, to me, this is people they are admitting that they might not have done the due diligence they thought they did, and they are realizing that they made a mistake and they're trying to get out of a company. That's what I think.
Right. And that's what they should do then, is make sure that they do that type of speculation in a taxable account.
Yeah.
Not in their IRAs or their Roths.
Yeah.
Be safer. A lot of people approach your IRAs and your Roths as more aggressive and more speculative. Mm-hmm. It's just the opposite. You know, you get the tax code benefits losses more than it does profits.
Yeah.
You know, it likes it losses. You know, you can use these losses to cut your taxes, but we're going to really penalize you if you take profits.
Yeah.
Okay.
So it's
don't speculate in your non-taxable accounts or your deferred tax accounts.
Yeah. So it's for that tax loss harvest. You get to spread that over 3 years at most, right? Because you can only use like, what is it, 3,000 a year or something like that?
Something like that.
Yeah.
I'm not an accountant, so I don't know exactly, but I know I put it that way. I know my corporation, which I'm closing this year, I still have some tax loss carry forward.
Yeah.
Carry forward.
Yeah. I don't know. I fell for the tax loss stuff when I first started just because I heard it and everybody's like, oh, and then like same thing with what do they say? The quadruple witching or whatever it's called, where they make a big deal out of that. I'm just like, what? Like, is that just the thing you're doing?
That's a good time. If you have a price that goes up on a witching hour day for the that's for options. That's what you're talking about. Yeah. When options mature, if you have a stock that goes up in price or down in price because of that, it's an artificial thing. And if it's one of your good, one of the ones you like or one of the ones that are in your list, it's a good time to either buy or sell.
Yeah. And then same thing with the when people do, like, I remember when I first started, this is all just stuff I've been through. Like when I first started and Tesla was doing really well, and they would do reverse splits with Tesla, or they would do splits with Tesla. And everybody, like, because it went from $800 a share down to $200 a share, everybody would just buy more. I'm like, it's the same thing. Like, it's
so crazy. It's the same thing. Exactly.
Yeah. I'm like, it's literally the same. Like, they literally just diluted you 4 to 1.
When they announced that split, you sell it. You sell on good news.
I don't know stuff. And it's just, I don't know, like, people that run the markets aren't idiots either. Like, they know that there's certain, like, hey, we're not getting the drum up, or we're not getting it. They're going to do something hey, everybody's talking about our stock again. Here we go. We're doing things.
Back to your tax loss things. One of the biggest, what I would call con, is when, particularly with corporate bonds and municipal bonds in particular, when they'll tell people they should buy short-term bonds, okay, because they don't fluctuate as much in price, which is meaningless that they fluctuate in price anyway.
Because
it's a fixed income, and it's a fixed, you're going to get your face value back.
Yeah.
Yeah. So they'll even encourage them to buy short-term bonds, even at a premium. What they're really doing is they're making themselves a what do you call it? Like a wheel. Each year, some of these things are maturing. Mm-hmm. When they mature, the guy has to buy another one. Mm-hmm. And every time he buys another one, he pays a markup to the company. And there's still more. There's no commissions anymore, but I understand there are still markups in the bond market. So when your guy tells you, when you get rich and famous and you have this portfolio of municipal bonds, and your guy tells you he wants you to get shorter maturities because they don't fluctuate in price, and he wants you to, you can take tax losses on them and get rid of them to buy more of them, more of a similar bond and stuff like that. Don't pay any attention. Buy closed-end fund muni bonds. You don't have to worry about any of this stuff.
So I don't know if you knew this or not. This is on topic, off topic. Did you know in Canada that they can only do mortgages for like 5 years at a time?
Seriously?
Yeah. So Dividend Dave, the guy that did one of my interviews, I told him that I have a 30-year fix at 2.75%. And he goes, we can't do, like, the mortgages in Canada are short term. And it kind of reminds me of what you just said. Like, he has to rely on the market to tell him what the interest rates are way more frequently than we do. So imagine in the United States, if they're like, hey, we're going to give you this mortgage, but it's a 1-year mortgage and you have to refinance at the end of every year. Like, that would be horrible.
Wow. That would be.
Yeah.
I mean, I've got, like you, about that same 2.75.
Yeah.
But I did it in a 10-year to get the rate.
Yeah,
down.
no, mine's a 30. Well, that was one of the things, like, as I was learning about like finance and stuff during COVID, like the refinancing of the mortgage, I was like, oh, I don't even know what that means. Yeah. But they were like, you can, I was at a 4.625 because I got it in 2018. And then during COVID, everybody was losing their mind. They were like, hey, now's a good time to refinance. So I refinanced and now I'm at 2.75.
Now let me ask you a couple questions. Okay, about that. How do you feel about when you make your mortgage payment? Do you pay principal?
No, I don't pay anything extra.
Okay. Not at that rate.
No. And see, that's the
thing. Know about the time value of money.
Yeah. Because like
you know how few people know about the time value of money.
The amount of people that I know that know so little about finance in general, just like, and like, it's not even like a shame thing. It's just like I'm a why person. Like if there's something that I don't know, like I want to know why that. But then I know it's almost never ending. Like same thing with dividends. I told you my journey started with a penny, and now here I am. That's because I ask why too many times is how that works. So like it's the same thing where like I hear about the interest rate and I'm like, okay, well, why does that go down? And then I started watching videos on like, well, when is it beneficial to pay extra? Because I was always told that if you pay basically an extra mortgage payment per year, it knocks 7 years off your 30-year mortgage. You're going to get it done in 23 years. But like that's also relation to the interest rate that you have on your mortgage based on the inflation rate. So what I watched is like, okay, 2% inflation, which I don't know why they call it 2% because like the 30-year average inflation rate's 2.5%. But like 2% inflation minus my interest rate is 0.75%. Can I get 0.75% returns from anything else instead of putting it on my mortgage? The answer is I can almost do that on accident. Like that's pretty easy. So you like my money is
pennies you pick up.
Yeah, exactly. Like my money is better spent on anything else rather than paying extra. Now, if you have like an interest, a mortgage of 5, 6, 7%, that's when you can start evaluating like, okay, you have to beat 4.5% returns year over year. That's a little bit harder to do than 0.75%. Right. Like you can evaluate that. But yeah, it's just something that like people aren't educated on. And then like, you know, we get to the point where everybody's 67, they're living just off of Social Security because they thought, you know, saving for retirement's like that's something you do when you're 60. And I'm just like, what are we doing?
And then they find out Social Security is taxable.
Yeah, they find out that. They find out it's also not enough to support living. And then they want to play the woe is me. And I'm like, well, I don't know. Right. Like,
okay.
That's all stuff. Yeah, that's all stuff I don't know. It's one of the things that I'm frustrated about because people don't care as much as they should. And like everybody thinks that someone's going to be there to save the day and nobody cares about little old you. Like that's just how it works. So, I mean, I do my thing to, you know, keep telling people the same stories over and over and over again. And some of them will listen, most of them won't. And that's not my problem. I just, you know, try to do what I can, but
I do the same.
Yeah. Okay. So I want to ask you maybe two more questions. Okay. So the question I want to ask you is, you've been doing this for so long and you've obviously been very successful at it. What keeps you going? And like, when is enough? Like, when is enough? You know what I mean? Like, when are you done doing this? Like, are you ever going to, you know, do your own horse riding lessons, or how's that going to work?
I guess it's in my genes. My father worked until he was 89. You know, and I don't see myself stopping writing or stopping helping people with their finances and stuff. I don't see that happening. Mm-hmm. So, and I think my wife knew that when she married me. Mm-hmm. and she realizes that she's not going to have my entire attention for 24 hours a day.
Yeah.
But it's just me. You
Yeah.
know, and frankly, coaching is a big cut in pay to what I was making when I was managing 110 million.
Yeah.
But it's great, and you have these one-on-one conversations with people. Like, I don't know if I've helped you in any way
Mhm.
in our chat, but I know that people that are listening to us with this conversation are going to benefit
Mhm.
from this conversation. And I feel the same way about when I coach somebody and I see a portfolio that's overweighted. I mean, seriously, I've seen people with $1 million in just 3 securities.
Yeah.
I mean, wow. I mean, that
Talk
makes
about
my
risk.
yeah.
Yeah.
Talk about risk. I mean, there's a lot of that out there
Yeah.
where people are, and a lot of it is in managed portfolios that people are not in the best of shape.
Mhm.
And rarely does a managed portfolio generate more than 2-3%. And then you get these model portfolios that people are in, and that's really, really crazy. So what if you own one share of Berkshire Hathaway? Is that really going to make you money?
Yeah.
You know what I mean?
Yeah.
So I see so much, and I try to encourage people to focus more on the income. But just like I've said to you, I think you could, with the same securities, without going into closed-end funds, you could make yourself more income by selectively reinvesting. Just that one change
Mhm.
in the long run would help you.
Yeah. Yeah. And that's something I definitely, like when I go to dividendchannel.com is like the site I use for like the drip returns and stuff like that. So anytime I'm doing like my Power 5 and I want to find a stock that's outperforming the S&P 500, literally select it for your time frame that you're doing, compare it to whatever indice you want to compare it to, and then it gives you two different charts. It gives you the one with dividend, like 10K 10 years ago with dividends reinvested, and then the one right below it is without. So you get to see that. So I mean, I think the drip is the most hands-off version of that. But I mean, I do dollar cost averaging every day. So like you do your selling every day. I literally buy little bits of all my stocks every day because my big thing was I overthink things and I don't want to be, I'm not really emotional in general. Like the wife doesn't like that, but like, I like to think of like things logically. So like one of the things I was able to do to take the emotions out of, like, I don't have FOMO. I don't have any of this stuff. One of the things I do is I just say, okay, whether it's going to be $2 or $10 or $15 in whatever stock I'm going to buy today, I'm going to put that in there every day, up, down, green, left, right. It doesn't matter. I don't care what's going on. I'm buying $10 of that stock every day. So like I just do that. And like over time, that's got me good prices on stocks. That's got me bad prices on stocks. That's got me everything in between. But over the course of time, I'm getting the average price of the stock. All the meanwhile, I'm still building up how much it's paying me in dividends and I'm building my shares. Where some people, like in some of the groups I tell this story all the time on these interviews. Some of the groups that we're in, I've heard people say that they wanted to buy, let's just say Apple, and they had a certain price that the chart gods or whoever told them that Apple was supposed to get to. And it got within, 5, 10, 20 cents sometimes of this price, but it didn't hit the price that they picked out of thin air. They never bought it. And I'm like, you've missed out on thousands of percent gain because you didn't buy Apple because you thought it was worth, 69.52
Right.
and it only got down to 69.55. I'm like, that doesn't make any sense. That's just as bad as tax loss harvesting. I'm like, what did you, like all these percent gains you missed because of 3 cents per share? I'm like, what are you doing?
There's so many of those types of things.
Yeah. And that's one of the, like, that's kind of like a fear story that I had for myself is like, I don't want to set some arbitrary, like there's some random number that I pulled out of thin air that I want XYZ stock to hit to. So I'm just like, I'm going to buy it. I know I want this stock. I know I want more of it today or next year than I have today. I'm just going to buy it every day. And I was able to, it's worked for me so far. There's strategies for sure that could work better, but there's also plenty of strategies that could work worse. So, but yeah, I don't know. It's just one of my things. And like over time, it's also adapted. So like the drip stuff, I'm not opposed to doing that. We're like, okay, let all of my dividends come into my cash position in my account. And because one thing, so I know what you were saying before about like drip can cause like overweighting in positions. So when I buy every day, I have a little chart at the bottom of my Excel sheet that tells me I want this stock now I only have 11 stocks. So I can't diversify, but only so much. So I have 11 stocks. So each one, like say it's 10% for this one, 11% for this one, whatever. I have the chart when I add my money every day that tells me in order for this stock to stay at 10% of your portfolio, you need to add this much to this stock and only this much to this stock. So like on Friday, when I got my special dividend from Costco, that was $99.11 that just came up out of nowhere. So like now all of my adjustments, like for the rest of the month, have changed to say, hey, you put a lot more into Costco this month than you were supposed to. So now we're not going to put any more money into Costco, and we're going to put more money into these other ones to keep you balanced.
Okay. So what you need to do, and believe me, I don't make anything by getting you to do what I suggest. I suggest you go and you find one income-based closed-end fund and one equity closed-end fund. I know it's a terrible idea to just try to select one out of this mass, but find one that's been around a long, long time and meets your intellectual needs, and just start adding one of each of those to your same routine right now, and just see how it pans out for you.
You can do those in like as little as $1 and everything, like regular stuff?
I think so. They're no different. They trade like stocks, so they're no different. You know, so you could buy $10 of each one and get started. You know, but just add 2 more positions to your 11 and start looking at them a little bit closer as a potential way of, instead of having 11 equities, of having 1,000 equities with the same money, with the same amount of money.
Yeah. Well, and that's kind of what I do with my Roth. My Roth is only ETFs. So like I have like the QQQM, the SCHD, the VOO. I have all that kind of stuff in there. One that
that's even a better place for closed-end funds because it's tax-free money.
So the newest position, I haven't even talked about this in any videos yet. The newest position I added in my Roth is a position by the name of f.i.r.e. And it is a 4 times leveraged S&P 500 fund.
Oh man, yeah. When the market was way down, one of my clients did those. So I asked my wife, "Hey, do you want to be aggressive in your IRA?"
Yeah.
I said there are these four things. There's I got to put my glasses on. There's URTY, UDOW, UPRO, and TQQQ. They're 3 times the average.
Yep.
The Russell, the S&P, the Dow, and the NASDAQ.
Yep.
And when we hit the bottoms,
in
my wife's IRA, I buy them. I set a target of 10%, and I'm out of them.
Yep.
So I've let a lot of money on the table, frankly, but that's a speculation for me. My heart starts to pick up pace when I do something like that, because it's against all my rules.
Yeah. Well, and so that it's a small percentage of the Roth. I just added it because I used to have QQQJ and QQQM. So QQQM is the NASDAQ, but then QQQJ is supposed to be like the next generation NASDAQ. And that one, it was just dogging for me. And I was like, I don't need to own both of these. I'm going to get rid of that. So I transferred that money into the other one.
Do the same thing. Take your profits and use the market cycle as when you buy them.
Okay. Yeah, I do like that. I mean,
you make a lot of money.
It is nerve-wracking on that one because you're just like, oh, there's some days where the S&P is down 0.2%, and that one's down a lot. I'm like, what the heck's going on? But
they didn't have those types of things. They didn't have any ETFs.
Yeah.
Until the 90s. So,
yeah.
I had to make my way without any of those neat things.
Yeah, it's cool. And like, I wouldn't, again, none of these are recommendations anyway, but like, I wouldn't recommend or suggest that somebody just YOLOs all their money into that stuff. Like that's way too skeptical. I wouldn't do that with any stock, to be honest.
You take a little piece of money and speculate when you've got enough money that you can afford to lose it.
Yeah, exactly.
If you can't afford to lose it, don't speculate.
Yeah. That's gambling at that point. So,
absolutely.
So I'm really curious. So one of the last questions. So I'm curious. I know you're talking a lot about diversification. I hear a lot of you have Charlie Munger, rest in peace. He used to say what diversification's I don't know, something that idiots do, where he was like, if you have really good convictions on your stocks, you don't need 500 stocks. You need, the 10 that you're convicted on. But then some people are super, super into diversification. So it seems like a really like polarizing topic in the industry, like investing in general, not specific to dividends, but like, what are your thoughts on it? What are your rules on it? Like, you don't like certain things to go over above a certain percentage. Like, how do you do it?
In my own personal portfolio, I don't own anything that is more than 2% of my
Mhm.
portfolio. And I've got a large portfolio.
Yeah.
5% is the absolute limit that I think anybody should ever have under any circumstances. You want something that if it goes to zero, it's a so what?
Mhm. Yeah.
It doesn't matter. It's not going to keep me from paying my kids' college tuition.
Mhm.
Okay. So 5% is my max. All my portfolios were always much less than that, even regardless of their size. The other thing about diversification that I really cover in the book uh, is I've taken diversification from a defensive strategy to an offensive strategy. With my coverage, that desktop I told you about with the 250 buttons,
Mhm.
if anything is going on in any sector, I'm going to feel the benefit of it in one of my closed-end funds
Mhm.
because I cover all the bases. So with my amount of diversification, I've really turned it into an offensive weapon for profits.
Yeah.
Where some people say they haven't taken more than 3 profits this year. I've been taking 3, 6, 9 a day. You
Yeah.
know,
That's really
so
cool. I actually just figured out that I could do something like that on Fidelity, where I can go, like, when you click on the stock that is in my portfolio, let's just say Apple, because we've been using it all day. But like, you click on Apple, I can see like what Apple's doing for the day and all the different numbers and metrics and stuff that they talk about. But I can also see, like, it says you can like set exit plans and stuff, and I can see like you're talking about, like the lots I bought them in. I can see if one of them's like long term gains, one of them short term gains, like how much this
right.
buy is up for the day or whatever. Like, it's cool to see that. And like, I didn't even know that you could do that on there. So I click around on Fidelity. I'm there every day. So I just click around
Yeah.
there sometimes
Yeah.
and mess around with it. But so that's pretty cool. But, and then, so when you say 2%, no more than 5%, and with the closed end funds, I get, so do you have diversification limits as far as it comes to like sectors as well? Like, I'm assuming that's bigger than, because 2 and
Yeah.
5% is like each individual holding, right?
Yeah. In the book, there's a risk pyramid that I created, or that my Facebook group and I created it together, where we categorized all the different closed-end funds, so the equities are all riskier than the fixed income,
Mhm.
just as the natural part of the game. So then each of the different types you can put into a different level of risk on this pyramid and get a sense for your overall risk level. And then when you realize that you've got a diversified portfolio of securities in that particular area, it's already less risky than having individual positions
Mhm.
in those areas. So you're you're minimizing a minimized risk platform in the first place.
Yeah.
You know, so yeah, I that's how I diversify.
Yeah, I like it. Like I said, I've talked to Kenyon was the one guy that I talked to. I think we have the record for the longest interview, Kenyon and I.
I think we're working on it.
Yeah,
now,
I know
aren't
we're getting there. And he's anti, like, he has a couple stocks that he's identified. He considers himself experts on those stocks, and he does very well with those stocks, and he doesn't really believe in diversification that much. And then Jeremy, the guy I keep referencing my second interview, he has so many stocks. I'm just like, dude, how do you keep up with, like, and those are like individual stocks or the closed end funds, BDCs, stuff like that. And I'm like, how do you keep up with all that stuff?
Did you ever hear of Payne Stewart?
I don't think so.
Payne Stewart was a professional golfer, and he was a very good professional golfer, green jackets and all that stuff. And one day he was on his private jet, or a private jet with several people, I don't know, and something went wrong. And that private jet just ran out of gas and crashed, and he was gone. Now, think about any company that you really think you know, and think about the board of directors on the private jet just flying along, and all of a sudden something goes wrong and they're gone. What if it had been Bill Gates on that jet that Payne Stewart was on? What would have happened to Microsoft stock? What would have happened to a company if their whole board wiped out and they didn't have the sense of direction? What if Musk has a stroke?
Yeah.
What if?
Yeah.
You just never, ever put yourself in a position where it can kill you if they die.
Yeah. Yeah. It's really just planning on do you know there's going to be ifs and buts? You might as well plan for them, I guess.
You don't know
Yeah.
anything when it comes to market. There's no KNOW, and there's no love.
Yeah.
You sell out of love. You don't sell out. Put yourself in a position that you never have to sell out of hate. You don't sell because you've lost a lot of money. You
Yeah.
want to sell because you've made money.
Yeah.
That's the work. Think about it just like you would anything else in the world other than stock market. If you were running a Walmart, guy comes in and offers you your markup, you sell it to him. No questions. You don't care. You don't care if somebody would be willing to pay more than that tomorrow.
Yeah.
You take your profit, put some other inventory on your shelf, and continue on. And then you really never have to worry like some people worry when the market goes down.
Yeah.
I never worry. I smile.
Yeah.
I know,
see, like you
I
did,
know I've taken my profits.
you're doing like a different version of like what I'm doing, where you took the emotions out of it. You're just like, hey, each and every day, like this is what I'm going to do. It's going to make me emotionless in the market. And that's a successful way to think about it. Cause the people that are the least successful or unsuccessful in the market are the ones that they're emotional, they're rash decisions, decisions. That was hard to say, but like just all kinds of stuff like that. And that's one of the things I've been trying to do since I started is like, how can I get rid of all that stuff? The things that make people unsuccessful in the market. How do I not have any of those?
And emotions are probably the biggest thing.
Yeah.
Do it. I mean, I've had people who've said, "Oh my God, the market's coming to the world's coming to an end as we know it. Sell me out."
Yeah.
I said, "You can't mean that. Sell me out." I said, "I can't do that. I'm not going to sell it for you. You have to call the broker yourself, tell him to sell you out because I'm not touching that, buddy.
Yeah.
Not me."
Do they end up doing that?
Yeah.
Oh wow. I was hoping that like if you put that extra barrier in their way, like maybe they'd think about it. But
sometimes they know more than you do sometimes.
Yeah. My grandma, my mom's mom, because she found out I'm into investing and stuff, and she's done really well for herself. But she called me, I don't know, 6, 7, 8 months ago. And she was this guy that she listens to. He has all these credentials and all kinds of stuff. And she was like, yeah, he was saying that Tesla's not a good buy anymore and I need to sell out of it. I'm like, well, what are you doing? And she was like, well, I'm up a couple 100% or 1,000% on my position or whatever. And I was like, oh, does he have like a courses for sale or something? And she was like, well, he told me to put it in gold. I'm like, okay, well, I mean,
oh my God.
I was like, fear is like the #1 emotion. It drives everybody to do anything that you want them to. So if you make a YouTube video, you put some fire in the background, people are going to listen to it, whether they should or shouldn't.
That's a thought.
Yeah. So, and I think there's only been one time on my channel, and I've done over 230 videos that I've put fire in the background of my video. And it was for one of the Yield Max funds. And it was genuinely one of the worst investments I've ever seen. Like it was a 10K investment. Like it was like a year ago would have been worth like $3,000 now. Like it lost you $7,000 in like 8 months. I'm like, was your 13% yield worth it or whatever it was? I was like, what are you doing? But okay, so I'm gonna group this last question into one. So somebody watching, so for the first part of the question is there are a bunch of myths and misconceptions in the dividend realm. We've already talked about one with like tax loss harvesting and stuff like that, and even like the bonds and like how people want to do short term and stuff like that. So are there any other myths and misconceptions that are in the dividend space that are just like not true and you want to debunk?
Well, I don't know. I think dividends are pretty straightforward. I mean, the company's got to be profitable to do it. One of the last things, it's a great quality check. Mm-hmm. One of the last thing a company wants to do is cut its dividend because it's taken as a negative of their whole, their whole business operation. Something's wrong in Denmark if, they cut the dividend. So I think anybody who buys a stock that is not paying a dividend is being more speculative. Mm-hmm. Than people who buy stocks that do pay dividends. Like I said, I've never bought anything that didn't pay me something. Mm-hmm. I've never I didn't buy zero coupon bonds. I want it every month, every quarter, whatever it is. I don't want it to add to the principal. So I get it 2 years from now. That's crazy.
Yeah.
I want that money till I can invest it. But, as for, there are some myths about closed-end funds, the fact that leverage is used to help generate the sizable dividends. Well, that's true of every corporation in the world. Mm-hmm. They all use borrowing. In real estate, it's all borrowing, for God's sake.
If you have a mortgage, you're using leverage.
Right. Yeah. I mean, we'd all be driving to work on bicycles if there wasn't leverage, right? People can't afford $100,000 for a car.
Yeah.
The same paid $3,000 for in the 50s or 60s. So yeah, dividends are a very, very important thing. Leverage is a way that we can get in closed-end funds, we can get you more income. And the other thing is return of capital, which happens in closed-end funds too, because they're so focused on dividends, on paying you a certain amount of money, they use managed programs. They're not gonna vary their dividend every month. They're gonna they're going to give you a managed amount of money, and then sometimes they don't make that much money, so they have to give you a little bit of principal back and so on. And people get upset about that. But what's a mortgage? If you pay the principal back, if you pay the principal that the guy's returning you when he pays his mortgage payment, you're losing capital.
Well, that's quite literally like an escrow account, no? Like when you pay for your insurance on your mortgage and you like pay a little bit extra, sometimes you'll get an escrow check at the end of the year like, hey, you paid a little bit too much.
Yeah, but still, when the guy, just like an annuity payment isn't all income.
Yeah.
It's mostly principal. And a mortgage payment, a mortgage that you own, not that you're paying. It's what you're paying, and it's mostly principal too. They're getting their principal back and interest. So it's the same thing with a closed-end fund. Occasionally, you're going to get a return of capital with it, but it reduces your cost basis. So it's a wash. A lot of people get upset with it. They think that the fund is going to go to zero because it's paying back money it doesn't have, which never happens. It just doesn't happen. Think about a treasury bill right now. A treasury bill you bought 4 years ago when interest rates were 1%. That treasury bill is going to be at 70, maybe 70. It's going to be $70 per 100. But you don't lose that. You don't lose that other 30 when the treasury bill matures. You get your $100. So it's they look at the wrong things, and there are a lot of misconceptions that you'll read about when I send you my book.
Okay. Yeah.
And then we'll have another discussion about the book.
Yeah. I'm down for that one. We may or not, we might do like a book review interview. That might be pretty fun. So, okay. Last question. We're going to end it with this.
Okay.
Somebody watching today decided that they're going to do dividend investing. They're also going to have a little bit of percentage of their portfolio in closed-end funds because you convinced them. So they decided that they're going to do dividend investing. They're going to have closed-end funds, and they're going to start investing. So other than just getting started, what tips could you give somebody that is going to get started? Or what tips would you give yourself? Like if you were 25 years old starting investing today, what tips would you give yourself?
Come up with definite standards of quality before you put a penny down. What are the quality requirements of any purchase you make? Make sure you know what that is. In our case, they must pay a dividend. In the old days, it used to have to be a B+ better rated company by Standard & Poor's, that type of thing. Diversify. If you got $1,000, buy two. The next $1,000, buy two other ones. Get yourself up to the point where you have less than 5% in your positions as soon as you can. Make sure income is generated by everything. Fourth one, set a profit-taking target for everything you own. There is no such thing as a core portfolio or a must-own stock. Buy it, take your profit, buy it again at some later date. Do that over and over. You can buy and sell the same things. There's no limit on how many times you can buy and sell the same thing. Okay, so always take your profits at a specific target. 5, recognize that we are in that there is a market cycle out there. There's a market cycle. That's the prices. There's an interest rate cycle, which also affects the regular market cycle. And every portfolio and every sector has their own cycles. So keep in mind where you appear to be in a cycle. You never know if you're at the top or the bottom, but you can certainly tell if you're close to the bottom or close to a top, and adjust your buying and selling accordingly. You sell faster at a top and you buy sooner at a bottom, that type of thing. And the final thing is, what is your focus? My focus is building the capital I have, building the number of hotels and houses on my monopoly board, okay, and building the income that they generate, so that every quarter to quarter, my income grows, quarter to quarter, my working capital grows. If you're doing that, you're doing fine.
Yeah. I mean, that's 6 good tips right there. Like those are, I always tell people, I'm like, come up with a plan that you can understand and you can stick to. Cause that's important. A lot of people come up with all these, they watch some dude on YouTube or some girl on YouTube and they come up with some extravagant plan that they don't even understand. They're like, oh yeah, it has to meet this metric. I'm like, you don't even know where to find that metric. Like come up with something simple that you can understand. Right. Diversification's really good, stuff like that. So I do like those. Call it
the QDI plus PT, quality, diversification, income, and profit taking.
Well, there you go. You got a
Those are the 4 pillars of risk minimization.
Yeah, I like that. Well, anyway, Steve, it's been a blast. Thank you for taking so much time out of your day to speak with me.
I enjoyed it too. It went fast.
I told you it's one of those things where I try to keep it to an hour, but you get 2 people in the room talking about the same thing, and you're like, none of us, it
especially
just keeps
two big talkers.
Yeah, right? Yeah. There you go. So, Steve, go ahead and tell the people where they can find you, about your coaching that you offer, your book. I'll put all this stuff down in the description of the video so you guys can check that out.
Well, the book is Retirement Money Secrets. Any place you buy books. It can be digital. It can be softback.
Do you have an audio book where you're reading it to us?
No.
Opportunity.
And the reason is because it's a conversation between 3 people.
Yeah.
And it's a Q&A between me and my Facebook group.
Yeah.
And it's got maybe 17 different charts and diagrams and things in it. So it'd be kind of tough to read that.
Yeah.
And it's very expensive.
To do audiobooks?
Oh yeah.
Oh, I didn't know that.
Yeah. So that the book, all the connections to my Facebook group and to my website, which is theincomecoach.net, theincomecoach.net, and they can determine if they want to talk to me about anything they have. But there's a lot of information, and through the Facebook groups, they're going to learn a lot of this.
Yeah. Yeah, that's really good. So like I said, Steve, you'll go ahead and send me that stuff after the interview. I'll put all that in the description of the video. So if you guys are interested in checking out anything Steve has done, will do, has already produced, make sure you guys give him love on there. And Steve, it's been a pleasure. We'll talk to you next time.
Yeah, very enjoyable. I look forward to seeing you on the Facebook groups too.
Yes, absolutely.
Take care, man.
And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.